Hi, good evening, everyone. Now, welcome to our Let's Learn Futures webinar series. This webinar series is brought to you by Bursa Malaysia and managed by our company, Excellent. Now, our topic for this evening will be timing your trade with price action strategies. Now, our session for today will be divided into two different sessions. The first 60 minutes will be presented by our speaker for today's CY Saw, and followed by 30 minutes of Q&A session. Now, my name is Ting Ting. I'm your moderator for this session. Now, before I start, can I check with you whether you can see my slides? You can hear my voice or not? If you can see my slides, you can hear my voice, can you please just type in the chat box 11. I repeat, if you can see my slides, you can hear my voice, can you please just type in the chat box 11. Okay, very good. I can see many of you managed to hear my voice, see my slides. Now, for those who cannot hear my voice, if you cannot see my slides, you can only follow this all. Okay, very good. Now, as usual, before we start, please turn off your video because when you turn on your video, it will take up a lot of bandwidth. So if you want to go through a very smooth session, please turn off your video. Now, along the way, while our speaker is presenting, you can start to ask any question if you do not understand. Now, how can you ask the question? You can just click at the bottom of it. If you're using mobile phone or you're using tablet, you can click on Advanced. Then you can search for Slido. Can you see this term Slido? Then you can ask any question. Now, please remember, do not type your question in the chat box because you can see our chat box will be flowing very fast later. We might miss your question. So I repeat, along the way, you do not need to wait until the end of the session. If you have any question, you can at any point in time type your question in Slido. Later, we will pick up your question. Please do not type your question in the chat box. Now, not only today's session, today we are the second last session for this year. We have our last session at the end of this month, which is next Tuesday. So next Tuesday, we have another topic, unlocking trading success with diverse styles and time frame. So if you are interested to register and attend the session, please scan this QR code or else in the chat box, can you see the link? Our admin already provided the link in the chat box. You can click on the link to register. Now, you can take a photo and later you can register, or else you can also share it with your friends because next week will be our last session. And subsequently for December, we will take a break and we are going to continue with next year Let's Learn Futures webinar series starting in January. So next year, we're going to start earlier. Do you manage to take the photo? Just screenshot or take a photo. Now, not only Let's Learn Futures webinar series, we also have Let's Learn Futures online workshop. Now, this online workshop is not suitable for every one of you. This online workshop is suitable for those who seriously wanted to get yourself started in futures trading. Then only you enroll to both the online workshop. So the online workshop, this will be the last session for this year as well. We are going to organize on a Saturday. Online workshop 1, the complete guide for beginners to futures trading and trading simulation. And followed by online workshop 2, how to create an effective futures trading plan and trading simulation. So my advice to you is please register online workshop 1 and attend online workshop 1 before you attend online workshop 2. So during both these online workshop, we are going to cover from A to Z, everything that you need to know about futures trading and how to submit your first order as well, because we are going to have trading simulation. So if you are interested, please scan the QR code to register, or else the same link, you can go and search and register accordingly. Now, we are going to open for 150 to register, and on the day itself, only the first 50 online attendees will be accepted. Now, just for information, this class is near to full, already more than 100 of them register. So please do not miss it. If you cannot attend, please do not register. If you can attend, then only register. If not, you are going to take up other people's space. Now, before we start with this evening session, please allow me to introduce our speaker for this evening. I believe you are very familiar with CY Saw. CY Saw is currently the lead hedging consultant, and he's also a chartered market technician, chartered holder with over 11 years of trading experience in local and international stocks and futures. He helps organizations in financial risk management and hedging. His specialty is in trading system and strategies, trading psychologies, and coaching. So without further ado, please allow me to pass it over to CY.
All right, great. Thank you, everyone. And good evening, everyone, and a warm welcome to all of you. And I hope you are doing well and feel ready to dive into today's session. And I'm excited to be here with you today as we are going to explore this wonderful topic, timing your trades with price action strategies. Now, here I'm going to share with you some practical insights about price action strategies in trading the futures market. For many traders, timing is everything. Entering the trade and exiting trades at the right moment can make a whole lot of difference in your profitability and risk management. Yet, oftentimes, traders find themselves entering trades prematurely, or they miss out on key opportunities simply because they haven't fine-tuned their approach to market timing. So today we are going to explore some of a few key price action strategies that you can use in timing your trades more effectively. So as you know, in the world of trading, market conditions can change rapidly, and price action provides one of the purest form of market analysis because it is free from all of those noises from indicators and the biases that comes along with those indicators. So price action tells a story, and it reflects the behavior, sentiment, and psychology of all market participants. So by learning how to interpret and act on that story, you can actually make more informed and confident trading decisions. Now, before we begin, I'd like to provide a quick disclaimer. This presentation is intended solely for educational purposes, and it should not be considered as investment advice or a recommendation to buy or sell futures contracts. And throughout today's webinar, I will be sharing with you some price action strategies that can be applied within the context of futures trading. Now, what I will cover today is intended as a set of reference points to enhance your understanding and refine your approach to trading. And with that being said, my hope is that today's session will help broaden your perspectives and deepen your knowledge when it comes to price action strategies in trading. So I believe Ting Ting has already mentioned earlier. My name is Chunye, but you can simply call me CY. And without further ado, let's go into today's content. Now, today I will be diving into 4 key topics that will help you understand the concepts about price action strategies. Topic 1, the background of price action trading. Where does it come from? Secondly, the fundamentals of price action trading. Once you understand the underlying fundamentals behind, you will know that this price action trading is no longer mysterious. Okay, it's not something new. It's all along the way. It has been there for quite some time already. And topic 3, the types of price action strategies. There are plenty of price action strategies. Here I'm going to share with you just a few of them. And lastly, finding your trading edge. Now, whatever trading strategies or trading approaches you use to analyze and implement your trade in the market, it all boils down into this thing is that you need to have a trading edge. So here I'm going to share with you a few tips how you can adjust to that and increase your probability of winning. So by the end of this webinar, you will have a deeper grasp of timing trades with price action strategies and be equipped with the tools you need to elevate your trading to the next level. So let's get started with the first topic, the background of price action trading. Where does it actually all comes from? Now, before I share with you, I would like to ask you a few questions here. Can we trade without any drawings or technical indicators or not? Okay, just think about it. If you don't use any drawings or technical indicators, can you do your trading decision? If you believe you can do it, you can type in yes. If you cannot, you can just type in no in the chat box. So later on, I'm going to share with you what is it all, this price action all about? Because, have you ever wondered before there is a computer, how does trader actually make trading decisions? Okay, so it all leads all the way back to the historical development of trading. When there is no computer, when there's no electronic devices, how can you do trading? All right, so I see there are a lot of mixture of our answers. There are yes and no's. All right, now second question for you is that to make it a little bit more clearer so you are able to visualize. So here, can you trade without any drawings or technical indicators? Personally, just only yourself, okay? If you can trade without any technical indicators, you can type in 1. If you cannot, you can just type in 0 in the chat box. So let me know what is your trading background here. So in this slide, you can see on the picture on your left-hand side is what we call as the bar chart. So it's the first form of opening high, low, close chart used, and with advances in computer technologies, software programmers are able to transform the bar chart to candlestick chart, as you can see on the right hand side. So I see a majority of your responses here is that most of you put 0. You are unable to trade without indicators. All right. If you don't draw anything by just looking at this chart, can you whether you can make good trading decision or not? Now, for those who answered 1 or yes, that means you probably have been practicing some form of price action trading strategies already. While for those of you who answered no or 0, don't worry about it. This session will introduce you about price action strategy so that there is another form of trading whereby by just looking at naked charts without drawing anything, you are still able to do trading as well. So what is price action? Now, to simply put is that let me give you a quick few definition to briefly introduce you about what is price action anyway. Now, that price action is about the analysis of price movement in the financial markets. So depending on what product that you trade, if you trade FKLI, FCPO, FGLD, or any other futures, it's about studying and analyzing the movements of the prices in the products over time. So the primary goal is to understand and ultimately predict the market behavior based on the raw price data by just looking at the opening, high, low, and close price, or even by just looking at charts, bar charts or candlestick charts. You are able to make decisions. Now, of course, this would definitely involve studying historical prices, because price action traders they analyze past market movements in order to identify patterns and behaviors that may help them anticipate future price actions. So historical data provides some of a few critical contexts for understanding market trends, support and resistance levels, and also potential reversals. And when you do price action trading, it means you are not relying on technical indicators at all. So unlike many technical analysis method that heavily rely on indicators like moving averages, RSI, MACD, Bollinger Bands, and others. So price action trading actually strips away all these tools. So you can see you can just trade with just only naked chart without relying on any indicators. And the focus is solely on interpreting price data. So this is often considered as the most direct and transparent indicator of market sentiment. And lastly, price action trading primarily focus on price movements, the price patterns, as well as formations. So later on, probably in topic 3, I'm going to introduce what are some commonly used patterns that the tools, the strategies that the traders use when they do price action trading. right? So these elements help traders to make informed decisions based purely on market behavior, just by the price itself. Now, just a quick introduction about the history of price action trading. So as you know, price action trading, it actually deeply rooted in the development of technical analysis. And it has been evolving alongside with the financial markets over about, a few centuries here. So while the term, okay, the word price action, it's actually relatively quite modern, but the concepts has been applied by traders and for many generations here. So here is a timeline tracing the evolution and the key ideas that have actually shaped price action trading. So here you can see the history of price action trading. It's actually a story of evolution, starting from early Japanese candlestick charts to sophisticated market analysis technique of the 21st century. So here you can see some of a few common names, which is also what we call as the market technician or technical analysis guru, like Munehisa Honma, Charles Dow, Jesse Livermore, Richard Wyckoff, and also Steve Nyson. All of them have contributed to the core idea of how to read price movements, trends, and patterns. So here you can see the early concepts is that it all rooted into it started with candlestick charts, where Munehisa Honma, where he developed candlestick trading patterns. And then later on with Jesse Livermore, which it's one of the traders, greatest trader of all time, where he just only using tape reading to read those stock ticker tape to make trading decisions. Then later on with the foundation of technical analysis, whereby Charles Dow, where he built on his Dow theory and market analysis. And as with advances in computer technologies, price action tradings continue to evolve to be more complex, and the market structure and dynamics also evolve alongside with technologies. So today, even though if you are just using technical analysis, is actually one form of price action trading. So later I'm going to introduce a little bit deeper on that. So here you can see today, price action trading continues to be a fundamental approach, especially for traders who prefer to understand markets directly. If you are not looking at fundamental analysis, if you're not looking at news, what price action trading is that you understand the market directly through price movements without relying on external indicators. So it's a form of, it's a testament to the timeliness of, human behavior in the financial market. Now, can you let me know, how does your trading screen look like when you look at charts? Okay, is it A, which is, you based on drawing support and resistance line, trend lines, or maybe no drawing at all? Or maybe is it B, technical indicator based? You have lots of indicator in your charts, like moving averages, MACD, RSI, etc. Or maybe combination of both. I don't know about you. All right, so I see a lot of responses here. Many of you are using A, all right, some, a lot of Bs, and also some a little bit more advanced and sophisticated using combination. All right, whichever method that you use, right? Of course, nowadays we call it, we generalize, we call it simply as whether you use A or you use B or combination, we just call it as technical analysis, correct? But however, I would like to share with you, how does this, whole technical analysis thing develop, so that you will be able to appreciate, the greatness in technical analysis, the advantages of price actions and also indicators. Now, in recent years, as I've already mentioned, the terminology price action has become widely popularized in the trading community. However, if you were to read technical analysis or trading books that is published before 2015 or before 2010, right, you would seldom see this specific term, price action, okay? Because instead of the term commonly used back then, most of the time we use technical analysis term, right? We just call it as price movements. So somehow or another, trading community use another different term, price action. So in fact, all of price action or price movement, it actually all refers to the same thing, all right? Because the shift in terminology can be sometimes a source of confusion for those of you who are new to trading or technical analysis. So sometimes you read blogs, articles, websites, YouTube's videos, or even different authors, educators, and speakers may use these terms differently, which can lead to misunderstandings about what they actually mean. So today, I'm here to clarify and break down these three key terms for you. Okay, price action, indicators, and technical analysis. And my goal here is to help you gain a clearer understanding of each concept so that by the end of this webinar, you will have the knowledge to differentiate them clearly. And by this way, when you encounter these terms in books or courses, you will have a much better grasp of what they represent and how they apply to your trading journey. Now let's start with the first one on price action. So price action, in fact, it is a trading based on the interpretation of your price movements without relying on technical indicators or complex calculations. So there is no mathematics involved here. There is no technical indicators. So it's like, it all goes back to the traditional old school of trading without computer. So this is where you just trade based on your ruler and your drawing only. Okay, so it's like you plot your price on your graph paper, and then you use ruler to draw support and resistance line and so on. So the core focus here is that the emphasis on analysis like candlestick formations, chart patterns or bar chart patterns, support and resistance levels, and also market trends directly from price chart itself. And the nature of trading signal is that it's actually sometimes quite subjective because it involves interpreting market behavior and also making decisions based on the observed price movement. And this oftentimes lead to a lot of different conclusions among different traders. And the good thing about price action is that it actually provides real-time insights because it reflects directly the immediate market behavior without any time delay in some indicators. And the learning curve, it's actually, I would consider this as moderate to high because it requires you to have a solid understanding of chart reading, recognizing patterns, and also interpreting the market sentiments. Now, good thing about price action is that it is a real-time signals with no lagging at all, and it often provides you timely decision making. Besides that, you will be also seeing that your charts, it's actually very clean. You have a clean chart without having having a clutter of multiple indicators plus drawing. Okay, it would make your whole chart looks too many things to look at, even more information. So here you can see price action trading. It makes it easier to just focus purely on price action. Now, the disadvantage also, this is something that I have to share with you, is that it is actually quite subjective in nature because the interpretation can be very different from trader to trader. And most importantly, it requires an extensive practice and skills to master price reading accurately. Okay, although you can see, just by drawing support line, resistance line, or looking at candlestick chart patterns, it seems very simple. But of course, because of its simplicity, okay, the challenge is actually on the subjectivity because it takes a long time for you to master it. Okay, for you to be able to interpret the chart accurately. Now, of course, price action, it's best used for day trading. Sometimes traders also use it for scalping, short-term trading, and also swing trading because of its responsiveness to price movements and the adaptability across various market conditions. You can use price action across different market conditions. So, which is why the flexibility of, if you are using price action trading, your flexibility can be very high. It can be adapted to different market environments, different trading products, and also adjust according to different trading styles. Okay, so here you have quite a brief understanding about price action strategy. Whereas for those of you who trade based on indicators, okay, in other words, we call it technical indicators, it is actually based on mathematical calculations applied to your opening, high, low, and close price. You will be using volumes and other market data that is generating from your mathematical calculations that is derived from your opening, high, low, close price, okay, in order to generate buy and sell signals. Now, the core focus here is, very simple. As you know, for those of you who prefer to use indicators, is that your core approach is, number one, you want to identify trends. Secondly, you want to know what is the momentum of the market, how strong is the trend. And lastly, you want to look at the market conditions through quantitative analysis of the price action and volume. So, earlier on, I shared with you price action and volume only, right? Without any mathematics involved. So indicators is actually, somehow or another, some mathematicians or statisticians, they use mathematics to apply into trading. So this is where they look at, price action, they look at price data, and then they derive their, it's like a mathematician way of trading. So this is where, there is a birth of technical indicators that is coming into the market. Now, the nature of signals for indicators, of course, it is oftentimes is lagging, and because they rely on past data, meaning they reflect on market trends or conditions after they have already started. But of course, the good thing is that the rule when you do technical analysis indicator-based trading, right, you are actually using rule-based signals. Okay, it is definitely unambiguous. The rules are very clear, straightforward, and simple. Uptrend or downtrend. There is no such thing as sideways when you are applying indicators. Now, the learning curve for indicator, of course, it's low to moderate. So you can see, sometimes people will say, using technical indicators to trade can be relatively easier to learn and use because it is a very straightforward calculations and predefined signals according to your trading rules. The advantage of indicators, of course, it is objective, it is rule-based signals that remove the emotions from your trading decisions. Because why? When you use indicators, ultimately you will be seeing the market, whether it is an uptrend or downtrend. There is no such thing as a sideways market for technical indicators. It's like, when you try to do a program using algorithm trading, right? Your indicator-based algorithm trading is also uptrend or downtrend only. There is no such thing as sideways for them. Now, it is very effective at confirming trends using indicators, and of course, they provide a very consistent entry and exit points. Disadvantage, of course, due to its lagging nature, meaning signals may appear too late and capture the full market price movement. And besides that, when you use indicators, you might be sometimes over-rely on indicators, and these can lead to missed opportunity or even false signals, particularly in a choppy market or range-bound market, meaning during a sideways market, technical indicators usually does not perform well. So when you use indicators, you are actually adding in more information for you to analyze, and that is why it takes time for you to reach your final decision. Now, the best use for technical indicators trading is that you can use it for trend following or momentum trading, where indicators can confirm and capture significant price movements, particularly in trending and volatile markets. Okay, as probably you might have heard of those, the story of the traders. They are purely, trading based on, their technical indicators. So this is where you can see the experiment for turtle traders is that they are able to develop a lot of traders, by just as long as they follow the trading rule of the indicators strictly, then all of them are able to capture quite a good reward following the market. Now, the flexibility for indicator-based trading is that it's quite moderate because indicators are typically rule-based, and it is less flexible and less adaptive to changing market conditions without manual adjustment. So which means you would still, when the market changes, right, for those who are very proficient in technical analysis, you would also generally would be adjusting your technical indicators a little bit according to the market conditions. Otherwise, for those who are, uh, foundational knowledge in technical analysis, you might just use the default indicators for trading across all market conditions without any adjustments. Now, lastly, which is on technical analysis, it is actually a broad approach to trading that combines price action indicators, chart patterns, volume analysis to make informed decisions. So, in simple words, is that in the olden days, they don't call it technical analysis. Technical analysis actually is quite a modern term, starting around the 1960s, because they combine a lot of different things already, including price action, indicators, chart patterns, and many other stuff to make it a way to trade the market by just looking at price patterns. Okay, they don't look at fundamental analysis. So during that time, in the 1950s, 1960s, if you are not using that fundamental analysis at all, right, then definitely your trading style would be actually technical analysis. Now, the core focus for technical analysis is that you may be integrating multiple tools and strategies to assess the market from different angles. So this provides you a more holistic approach to trading. Now, the nature of signals can be mixed. It can be subjective or objective depending on the tools and strategies that you use. So some signals might come from price action, while other signals may be based on indicators or price patterns. So the signals can be a little bit mixed depending on what kind of trading signals that you rely on. Whether is it lagging or leading indicator, it's in fact both, depending on what tools you use in your technical analysis. If you are using signals that is leading, which means you are able to anticipate price movements better. If you're using lagging indicators or lagging tools, which means it reflects the past price behavior better, but it reflects what are the current changes in the market a little bit slower. So if you want to combine too many things, price action and also indicators in your trading, so which means you will be looking even more information already. So the learning curve, I would say it's quite a little bit high, because this approach requires mastering, multiple methods and understanding how they complement each other. The advantages is that, of course, it provides you a comprehensive view of the market by combining various tools for better accuracy and decision making. And it allows you to have more refined strategies by blending different techniques. Disadvantages, of course, it can be more complex and overwhelming, especially for new traders. So if you are new in trading, I suggest you to either focus on indicators or price action. Then slowly, as you gain a little bit more experience, you can actually combine more things, and it forms a technical analysis already. Now, the best use for technical analysis is that it's suitable for all trading styles and markets, as it allows traders to adapt your trading strategy to a variety of conditions by using a combination of tools. So for those of you who have keep learning technical analysis, if you have broader knowledge of technical analysis, meaning you have already mastered price action strategies, you have learned a broad base of technical indicators, you have learned a lot on sentiment analysis. So which means your technical analysis toolbox, it's big enough. All right. So when you have more tools in your toolbox, you have higher flexibility. So this approach offers a lot of flexibility that allows you to mix and match different tools and adapting your strategies to the evolving market conditions. And lastly, one thing that you must understand is that every approach has its strengths and weaknesses, and many traders often combine them to create more robust trading strategies. And the choice largely depends on your style, your experience, and your own personal preferences. So price action offers a clear real-time view of the market with no lagging. Technical indicators provides objective rule-based signals. However, it might be a little bit lagging. Whereas if you combine both of price action and technical indicators, it becomes a more comprehensive technical analysis. So in the end, the best approach depends on your own trading style, your goals, and your experience level. So each method, in fact, it can be effective when used appropriately, but you need to understand their strengths and weaknesses. This will, in fact, allow you to decide which is the most suitable for your trading strategy. So especially for those of you who are relatively quite new in trading, it's best for you to, take time to do trial and error. Try everything, okay? Because this is, no matter how, it is just a learning curve for each and every trader to find what are the things that suits you most. Now, the second topic I'm going to share with you on the fundamentals of price action trading. So once you understand the underlying fundamentals of price action trading, it will no longer seem mysterious, because at its core, price action is simply the analysis of price movements to identify trends, reversals, and the key market levels. The beauty of price action is that it doesn't rely on complex indicators or external factors. It's all about reading the market as it is. So when you are able to grasp the core essential principles of price action, you gain a deeper understanding of how the market behaves and how to make more informed trading decisions based on price itself. So let's have a look. What are the assumptions of price action trading? So there are several price action assumptions that you must know about, because it is actually the assumptions of the market behavior and how price moves. And these assumptions guides you in making decisions purely based on price charts and price patterns. So here are a few assumptions. I will just briefly go through it. If you are a practitioner of price action trading, you believe that the price reflects all available information. You believe the market is actually indeed efficient, because the current price of, whether you look at FKLI or FCPO, the current price reflects all available information in the market, such as the news, economic data, and the market sentiment. So this means the traders, the market participants in the market, believe that all the factors influencing the market are already priced in. So there is no need to look for external information. Because whatever information, fundamental information that they already read, right, they have already taken their action in the market already. So if you are studying how price move, so you will be actually interpreting the price action, the story that the market is telling you, and you use this price to anticipate future movements. Secondly, you believe that the market actually moves in trends. This is one of the core beliefs, that market does not move randomly. There are patterns, there are trends, because when price move up, it means it's a uptrend. When price move down, it is a downtrend. When it is a sideways, meaning it is a range-bound market. So the trend persists over time because of the consistent buying and selling behavior. So traders oftentimes aim to identify the directions of the trend in order to trade the direction of that particular trend until there is a sign of a reversal. So for example, in an uptrend, price action trader will look for buying opportunities. Thirdly, you will believe that history repeats itself. Now, if a specific price pattern leads to a particular outcome in the past, there is a high probability that it will do the same in the future. Because as traders, you analyze patterns like double tops, head and shoulders. You look at candlestick chart formations based on this belief. Now, number 4, price move in waves. Now, traders look for waves like movements in order to identify trading opportunity to enter or even exit trades. So for instance, in an uptrend, you might enter during a correction when there is a pullback in an uptrend. So you might be finding opportunities, some short-term uptrend reversal pattern in order to capture the next upward price movement. Now, besides that, number 5, you believe support and resistance levels are actually an important key levels, because they represent a psychological point where buyers or sellers dominate at that particular level. Because when price approaches these support or resistance levels, traders watch for signals of a breakout or even reversal in order to make trading decisions. You believe market sentiment actually drive prices, so which is why you're using price action. By interpreting price action alone, you are actually interpreting the emotions of the market, because the price reflects all the emotions of the market participants at that particular time. Besides, price patterns are in fact self-fulfilling prophecy, because not only you alone using price pattern, other traders are also using maybe also using price pattern. They may also be looking at, for example, if you are looking at an double top or head and shoulder patterns, other traders will probably be looking at the same thing as well. So if you are taking, let's say, if you see there is a downtrend reversal, right? Other traders will be also taking a short position like you. So which is why it makes price pattern self-fulfilling. Now, besides that, why do you need to do price action trading? As you know, that price action is actually good. There are a lot of advantages because of its popularity. It's a popular choice among traders because of simplicity and clarity. Because the focus of price movement, it eliminates the complexity of using multiple indicators. So it makes it easy to understand and apply. It's applicable to any markets, whether you are trading stocks, commodities, futures. Price action strategies work across all markets. It works across on multiple timeframes as well, because it is actually quite commonly applicable, even though for intraday trades to longer term strategies. It is based on real-time analysis, since price actions focuses on current price behavior. So it enables real-time decision making, allow you to make a decision based on real time. Price action, also good thing is that it understands market psychology. Now, when you do price action trading, when you are master of price action, right, you are not just only looking at support and resistance level. Because support and resistance level is just only a tool for you to draw lines, right? What you want to see behind those support and resistance is that you want to understand what is the the driver behind the support line as resistance line. So when you study price movements, you will be able to gain insight into the market sentiments, helping you to predict potential trends and also reversals. As I've already repeated multiple times, price action, you are able to avoid lagging indicators. So unlike traditional technical indicators, which oftentimes lag behind price movements, so price actions provides you immediate feedback, so you can reduce the chances of missing important move. You are able to adapt to different trading styles, whether you are a day trader, swing trader, or someone with a short-term trading approach. Price action trading can in fact help you tailor your unique trading style as well. And lastly, you can reduce the dependency of on external tools, because price action trading, right, it minimizes the need for complex software and excessive indicators. So it keeps your analysis clean and straightforward. So especially like nowadays, sometimes you trade through your mobile phone by monitoring price movements, right? Or sometimes you might monitor your price through your tablet. So the screen is very small. Drawing putting indicators or doing a lot of trading might be taking quite some time or not convenient. So if you're using price action trading, you can actually immediately interpret the market quite quickly. So you can see this actually focuses on the the most relevant data, which is the current market price, for you to make real-time decision. Now, just a quick exercise for you. Now, when you look at this chart, right, on the far right-hand side, in this, 4 or 5 green candle bar, would you take this trade or not? If you are willing to take this trade, you can type in yes in the chat box. If you are not going to take this trade, you can type in no in the chat box. So later on, I'm going to share with you what are the things that you should avoid when doing price action trading, because oftentimes, when traders learn about technical analysis, especially candlesticks, right, they might be they are reading correctly, okay, because the book says so. But in fact, when it comes to actual application, it might be a little bit different. So which is why for traders, we want to be a little bit more pragmatic. We want to be more practical. So for example, in this chart, you look at four green candles together, okay, consecutively. So sometimes you might be interpreting it's three white soldiers, okay. It is actually a bullish continuation pattern, okay. But do trust me is that in futures market, right, oftentimes when you see this kind of three white soldiers or four white soldiers, right, you need to look at okay, I teach you to interpret this pattern. You can see the first green candle. It is a long candle, and then the candle is getting shorter and shorter. Right, so you can see the price movement, the push is actually getting lesser and lesser. So which means, in other words, it loses its strength already. So when you see a final candle is getting very smaller, right, it means the trend is actually about to reverse. Okay, so if you look at the far right hand side, yes, eventually you can see the trend is actually quite considered about the end. Okay, so here few things. Number one, you can choose to avoid this trade, and number two, you can find an opportunity for a reversal there. Okay, now another quick exercise for you. If you look at this a consecutively downtrend, and you look at the far right hand side, there is a doji pattern here. Okay, there is a cross pattern here. Would you take this trade or not? If you're willing to take this trade, you can type in 1 in the chat box. If you do not want to take this trade, you can type in 0 in this chat box. Okay, I see multiple answers here. Some yes, some no. Some would say wait for confirmation. Okay, now all of you, of course, I don't know about you. Different people comes with different level of understanding in technical analysis, and different levels and interpretation of price action and technical analysis, right? So which is why you can see, by just looking at price action, right, different people will interpret it very differently. As we look at this chat box here, we have a mixture of answers. So yes, there will be traders doing buying, there will be traders that are taking a sell position. Some traders do nothing, waiting for more confirmation, more information about the market. So all of you, you are right in your terms, okay? Because ultimately it is based on what strategy, what is your rule for trading the market. So if you are follow strictly on technical candlestick chart analysis, right, looking at a doji, especially after a downtrend, right, a long streak of downtrend, so likely we will be saying that it is considered quite a reversal pattern by just using only one candle itself. But some traders, yes, you will be looking at more informations. But yes, if you are taking this particular trade, probably you might need to be, a little bit more patient for the trend to reverses back up again. Okay, so which is why it is important for me to briefly explain it to you in this topic 3. What are the types of price action strategies? So that you understand what are the strategies are considered as price action. Now, there are many different price action strategies in futures trading. As you already know, price action strategies, in fact, is actually the most old school way. Okay, but old school does not mean it is not effective. Old school, it has its own advantages and disadvantages, as I have already shared with you just now. So old school way of method is that they don't use they may or may not use drawings. They definitely do not use indicators, because indicators, you have to do a lot of calculation. You need to be a little bit more well versed in mathematics. And of course, in olden days, if you are doing calculations, right, you need to do it manually. And even if you have calculators, you have to do it all by yourself every single day. But nowadays, with advances in technology, computing technology, we do not have to, calculate manually by ourselves. But, if we are referring to price action strategies, we are actually referring to the old school way of trading. Okay, so what it means is also that you will be using, for example, support and resistance levels. You will be doing trend following. By using trend line, you will be doing breakout trading. You may be looking at reversal patterns and also using Fibonacci retracements. And there are several other methods as well. So here I'm going to highlight 5 key most frequently used methods for price action strategies. So the first one on support and resistance level. So the concept here is very simple. You will be using support and resistance line. So support and resistance are key levels where the market has historically reversed or consolidated. So which means a support line refers to a price level where a downtrend is expected to pause or reverses due to increased demand. There would be buying power there when prices reaching support level. Whereas for resistance line, okay, resistance level is actually a price level where an uptrend is likely to, loses its steam or it is about to reverse, because there would be increasing selling pressure near resistance level. There are a lot of ready sellers ready to sell and get out from their position. So this is what we call as the resistance level. So the strategy for using support and resistance level is actually relatively simple. So number one is that if you are doing entry strategy for a long position, you will probably enter long near support levels because you expect the price to bounce higher. And consecutively, you will be take a short position near resistance level because you anticipate the price reversal to the downside. So here in this chart, you can see here on the far right hand side is that because previously there is a same high price, right, at a similar level. So you draw a horizontal line across. So you can see on the right hand side when prices comes near the resistance level, so which means in the past those who would want to sell, right, and they haven't sell yet, so now when the price approaching to a similar level, they are already preparing to sell, or they are actually doing the selling activity already. So this is where you can see it is actually, it is not just only resistance level. You need to understand what is the psychology behind support and resistance level. So for resistance level, the psychology behind means there is a lot of sellers there. Okay, so here you would be entering a short position when the price near the resistance level, because you anticipate the price may be reversing. And another strategy is that you may be taking a long position near support level. So when the price approaching to a well-established support level, it is actually showing a sign that a reversal, such as there would be a tentatively more buyers coming into the particular price level. So you can actually enter a long trade and anticipate the price to bounce back up higher. Now, by identifying and trading around these critical price levels, right, you're able to capitalize on price reversals. But the challenge here is that you need to be able to draw a valid and reliable support and resistance line. Secondly is that on trend lines, okay, so trend lines is mainly for trend following. You would want to identify the prevailing market trends, either uptrend or downtrend, and you trade according to the direction of the trend. So uptrend, the characteristic is that you want to look at higher highs and higher lows. So this is where you connect a line there. And of course, if you're doing trend line, you need to constantly adjust your trend line so that you have a reliable trend line. So the strategy here is actually relatively simple, is that for trend line, when the market is an uptrend, price is above your trend line. So you enter long positions whenever the price pulls back to your key support level, or after confirming there is a higher highs or higher lows. So these are the typically a strong entry point for trend following traders. So here you can see when do you want to change from a long position to a short position, instead when there is changes in trend. Okay, when prices breaks your trend line, it signifies that the trend has already changed. Now, another example, trend following example on downtrend is that for downtrend, the definition is lower highs and lower lows. These are the characteristics that you must understand, because this indicates there is an increasing selling pressure. So in the downtrend, you want to enter a short position after the market creates a lower high. So a lower high and lower low means the market is actually weakening. So when the price has already broken down the trend line, so here you can see you can draw a downtrend line here. But if you are doing drawing, right, it means oftentimes you definitely have to keep adjusting your trend line according to the changes in the market situation. Okay, so on the far right hand side, you can see how do you know when the downtrend change is that when the price goes back up above your downtrend line. So this signifies that the downtrend has already reverses. So this is number 2, the trend following method of using price action strategy. The third method, which is the breakout trading. Now this involves entering a position when the price breaks out a defined range or chart patterns, such as a triangle, rectangle, or support and resistance line. So breakout signals is actually a potential for a strong price movement in the direction of the breakout, because market participants, they react to the new information or the momentum. So if you want to use breakout trading, now the criteria here is that first, you must master support and resistance method. Okay, you must be able to draw a valid and accurate line. Secondly, you need to be able to trade with a support and resistance first. Okay, so once you have mastered method 1, method 2, then only you use method 3. Because for breakout trading, for example, in this case, once you are able to draw a valid resistance line, okay, you can see whenever there is a breakout, which means the price breaks out your resistance level. So this is a good time where you can actually take a long position when price breaks above resistance level. So breakout trading may or may not for everyone, because the speed here is a little bit faster than the normal support and resistance or even trend following trading, because once the breakout happens, there would be a momentum that actually speeds up or accelerate the price movements, whether is it up or down. Now on the right hand side, again, you can actually draw a support line when the price breaks down the support level. So which means there is another downtrend of breakout trading. So when price breaks support, you can actually enter a short position anticipating the price to come down. Now, number 4 is on reversal patterns. Now, besides drawing support and resistance line, you can also look at reversal patterns. Now, these reversal patterns, I would like to simplify it a little bit. Here, I categorize reversal patterns into 3 major types. Okay, I understand technical analysis comes with a lot of things, right? But you can actually refer to this method. Okay, you break into 3 different types, then it will be easier for you to learn price action and also technical analysis. Now, first thing is actually on immediate patterns, whereby you just only look at 1 to 3 candlestick and that's it. The short-term patterns, you will be looking at 4 to 10 candlesticks, whereas for medium-term patterns or long-term patterns, you will be looking at least 15 candlesticks or more. Now, let's have a look at immediate patterns, where you look at 1 to 3 candlesticks. So reversal patterns is actually signifies a potential trend in the direction of the market, whether is it an uptrend or downtrend or vice versa. Now, these patterns can form over 1 to 3 candlesticks that are considered intermediate short-term signals. So recognizing these patterns allows you to enter trades at the very early stage of a trend reversal. Sometimes by just looking at one candlesticks, of course, there are several criteria you need to meet at. You need to know where is the position of the candlesticks, okay? So in order to use 1 to 3 candlesticks so that, your trading strategies would be more effective, your probability of winning it would be higher. Now here you can see there are also bullish reversal patterns whereby you can actually enter long position when you see bullish reversal patterns. Bullish reversal patterns happens whenever there is a downtrend already. So whenever a bearish trend, so the next thing what you want to look at is bullish reversal pattern when the bear is trying to reverse. Whereas for a bearish reversal pattern, you enter short positions when an uptrend shows a sign of reversing. So by trading these immediate reversal patterns, you can actually capitalize on early signs of trend changes and entering the market at a potentially profitable point before the full reversals actually take place. So you can see on the top we have 1 candles only. On the second one we have 2 candles patterns. We also have 3 candles patterns. So when you do these immediate patterns, right, your entry point to the market is just at the reversal point. Okay, your entry point is actually can be at the tip of the reversal point. Of course, your reward will be high, and so does your risk, because you do not seek for additional information. You do not seek for additional confirmation. So when you use these immediate patterns, right, 1 to 3 candlesticks reversal, you believe that the market psychology has already reflected in these 1 to 3 candlesticks. So that's the reason why you take the trade and trading on reversals. So of course, high risk, it also comes with higher reward. Now, for short-term patterns, you will be looking at around 4 to 10 candlesticks. This is because you can't use the immediate patterns. So you need more price information to make decisions. So for example, if you are trading a futures product that is not volatile, for example, on the left-hand side chart, like using the FKLI 1 minute chart. So it's a little bit difficult for you to interpret the chart, am I right? So there is no visible or a standard reversal candlestick patterns here for you to identify. So how you can solve this problem is that there are 2 methods. Number 1 is that you can combine few candles into 1 candle. Now, of course, combination of candles, this might need your imagination a little bit, and it's a little bit tough. Or you can use the second method by using a higher time frame. So instead of using 1 minute chart, you can use 5 minute charts, 15-minute charts, or even 30-minute charts, or higher to spot your reversal patterns. So 30 minutes chart, in fact, is actually a combination of 30 1-minute candles. Okay, so here you can see with advances in technology, right, you don't have to redraw your chart. You just find a place to change your time interval for your time frame. Okay, from 1 minute change over to, let's say, 5 minutes or even 30 minutes. So you can see this 30 minutes chart, it might provide you a better accuracy in terms of identifying your chart compared to in 1 minute chart to look at candlestick movements. So sometimes even when using daily charts, you might not be able to spot any clear reversal patterns also. So for example, this FKLI chart, it is not volatile, it is slowly trending. So again, you need to combine few candles into 1 candle to make decision. And this requires a little bit on your imagination. And of course, if you can't identify any clear standard reversal patterns here, so what you can do here is that instead of using price action strategies, you can actually focusing on medium-term patterns. So medium-term patterns, of course, it would take more than 15 candlesticks. So here I'm not going to be lengthy because I believe most of you can find this information over the internet. These are the very common longer time to form reversal patterns like double top, head and shoulders, triangles, flags. Okay, on application, you can see on this FKLI chart here, we can see on the far left hand side, we have ascending triangle followed with a flag and irregular double top. Now, lastly, which is Fibonacci retracement, a commonly used, which is also what we call as the Fibonacci ruler. So by using these levels, you are able to identify potential levels of reversal using retracement. So how you are going to trade with this strategy is that you need to be able to draw or connect Fibonacci measures by connecting the recent top and recent bottom and trade according to the Fibonacci levels. So usually the popular Fibonacci levels like 38.2%, 50%, and also 61.8%, they are generally used as a common support and resistance level. So in this chart here, you can see by connecting to one bottom and one top, right? You can see when the price draw back down, you can see here there are a few good support zone. Here we have, 38.2 support. You can also use 61.8% as a support level as well. So which is why you can see doing price action trading, sometimes it can be a little bit self-fulfilling. However, these are just only tools for your reference only. You still need to find your personal trading edge. So whatever trading strategies approach that you use to analyze and implement your trade in the market, you still need to have your edge. Okay, here I'm going to share with you several tips how you can do that. Now, of course, we need to understand what is our edge. Of course, edge refers to our strategy or approach that offers a higher probability of success rather than random chance over the long term. Of course, this involves consistently identify traits that have a favorable risk to reward ratio, and this gives you achieve a profitable trades after executing this strategy over time and time again. So there are a few criteria here. Is that number one, you want to make sure that you have a high probability of winning trades. Number two, you want to make sure that when you win, the amount of each winning trade is actually very high so that you are able to cover your losing trades. So in other words, it's also what we call as our risk to reward ratio. So how to find your trading edge is that you can actually follow these 4 simple rules. So number one, you need to increase your probability of winning trades. So you need to identify trade setups that has a higher likelihood of success. Now this involves using technical analysis, chart patterns or other tools that able to help you identify favorable conditions of entering the trades. So this is you can do so by consistently identify trading setups, okay, patterns that have a higher win rate. So you are able to improve your overall probability of success in the market. When you increase your probability of winning trade, while at the same time you can also reduce the probability of losing trades. So some of the signals, right, you can minimize those losing trades, because even though you have signals of entering a trade, because if you do your back testing well, if you do your study carefully, even though there is a signals, however, those signals may provide you a low probability trade. For example, some candlestick patterns may not be good in trading the futures market. For example, if you are looking at earlier example I shared with you, 3 white soldiers or 3 black soldiers, those might not be a high probability winning trade. So when you reduce all of these losing patterns, right, eventually you are also reducing your probability of losing. Now, number 3 is that when you win, you want to make sure the amount that you win is actually high. Because when you increase your probability of winning, you also want to focus on maximizing the profit that you make from each successful trade. And this can be achieved by ensuring that you capture more profit with a significant move in the market, because you want to let your winners run while sticking to your predefined risk to reward ratio. So you want to aim to profit from a winning trade rather than having too much losses on your losing trades. You also, number 4, you also want to try to reduce your amount of losing trade by implementing good risk management strategies like stop loss, effective stop loss, cutting loss earlier, having, refine your entry and exit points. The goal is actually to reduce the frequency and the size of each losing trade. So this would actually, with all of these four things together, it will actually improve your overall profitability of your strategy. Okay, so when you have all of these four criteria together, you are actually developing a trading edge that works in your favor. And this will actually help you consistently grow your trading account over time. Now, how to increase your trading edge? Number one, always test your trading strategies. Backtest your trading strategies before you risk your real capital. Because when you do your trading, test your strategy, right? You know what works, what doesn't work. So you want to, when you trade with real money, right? Of course, you want to use strategies that works well, and you want to, drop off all those strategies that does not work well. You can actually drop off strategies that has low probability of winning. So this is it actually gives you a trading edge already. Now after you have tested your strategy, you can actually start trading small. Because begin with trading small size number one, it allows you to minimize your risk while you still have time to keep refining your strategies. And this allows you to gain practical experience without exposing yourself to large losses. Because using smaller positions can also help you build confidence and understanding the ins and outs of your strategy in the real markets. When does it perform and when does it not perform well? Number three, when you start trading small, when you gain consistency in interpreting and executing in the market, right? When you are able to spot the price patterns accurately, this is where you gain consistency. You can track your trades and note what are the patterns and keep refining your trading approach. So this is where number four comes in, is that strategy refinement. You continuously review and refine your trading strategy, keep adjusting to a level that you increase your probability of winning. What are the trades that is good to take? What are the trades that you can avoid even though there is a signal? Okay, so this is where ultimately it gives you a very good trading edge. So you keep repeating step one until step four until you are confident, and this is where you can start to scale up your trading. So from one contract, you trade two contracts you trade three contracts and more. So once you achieve consistent success with small trades, you can gradually increase your position size. Now, several criteria for success when you do your price action trading. So number one, of course, you need knowledge in all of those price action tools. Number two, you need to have a skill set that you must have. Now, which is, if you're doing price action strategy, number one, you need to recognize price patterns, which means you need to be able to train your eyes to spot differences and also to spot the sameness. Because a lot of people, I notice is that they keep memorizing all of those chart patterns, memorizing candlestick patterns, but they don't train their eyes to spot those patterns. So it's very important for you to be able to train your eyes. Number two, you also need to train your eyes and to have a consistency in your interpretation so that each and every time when you interpret, right, it is actually as accurate as possible. Sometimes if you have lack of practice, you might interpret your chart incorrectly. So you need to make a lot of fast decision making, because oftentimes those who do price action trading, especially if you rely on immediate price action using 1 to 3 candles or even up to 10 candles, you need to be making quite fast decisions. This is where you need to have a lot of practice to continue to refine your strategy, and always for all trading, no matter what strategy that you use, you need to have a lot of high discipline. You need to have a lot of patience in waiting the signals appear, and also to have a good emotional control and regulation, not to have greed, not to have getting letting emotions getting out of control, and you trade randomly. And lastly, of course, your criteria for success is that you need to have a good trading strategies, no matter what. You need to have a list of profitable trading setups. You need to continuously test through trial and error. Once you develop being able to identify what are the good trading setups, which means what are the setups that has a good high probability of trade, you can rely on those trade, then you keep improving on it. Add risk management into it. Like for example, to determine what is your risk reward ratio, where you are going to cut loss, how to position, increase your position or reducing your position. So all of these things, again, we all fall back into how to develop your trading edge. So here are the general rules. How you can do that is that number one, you can filter out all of those lousy trading setups, even though you are able to see trading patterns, because all of those trading patterns are low probability of winning. Okay, so you might want to avoid all of those trades. You want to only keep those high quality and good trading setups. So this is where you will be able to enhance your probability of winning. Okay, so if you want to enhance your probability to win in trading, you can do even further. It's actually, as you know, you are doing price action trading, you are doing technical analysis. If you want to improve your probability, is that you definitely have to include more information in your consideration when you do decision making. And that means you include fundamental analysis, you include news, you include event-driven trading to take, some of the trades whereby, whenever certain news comes out or certain special cases, you can actually take those trades, okay, those meaningful trades that is having a high probability and can also make quite a big home run trade from that. Okay, so of course, if you increase a lot of information, you will definitely increase complication and there are more factors for you to analyze. So that's it for key takeaway for you on price action trading, is that price action trading is definitely not new. In fact, it is what we call as the old school of trading. There are a lot of advantages of price action trading because it keeps your price chart very clean. And there are several price action trading strategy you can look out on. And most importantly, you can take a picture of this slide, is that what are the ways that you can do to increase your trading edge. Start by testing your trading strategy. Start small, and until and unless you gain consistency in your interpretation and execution, then you need to keep refining before you be able to add the total number of contracts of your trade to scale up your trade. All right, so that's it for my sharing. So hopefully you have a good understanding about what price trading strategy all about, because I understand this can be a new term for you, but in fact, price action trading, it actually refers to trading with minimal drawing or technical analysis. So that's it. I pass it back to Ting Ting.
Okay, thank you, CY, for informative presentation. Now, currently, we are going to move into the Q&A session because we are running out of time. So you can start to submit your question in the Q&A box. How do you submit the question in the Q&A box? You just need to click at your Slido. If you're using mobile phone or tablet, you can click on the Advanced tab, and you're going to see this Slido. Once you click on it, you can submit your question in any of the languages, English, Malay, Mandarin. It's okay for us. Now, meanwhile, while waiting for your question, can you please provide us a quick feedback? This feedback form is less than 1 minute. You should be able to finish everything, maybe 30 seconds. Some of you might be able to finish as well. So nothing that we requested from you for this evening. The only thing that we require helps is to provide us with your feedback. So what you can do is there are two ways for you to access to this feedback form. First is you can take your mobile phone and scan this QR code. Alternatively, in the chat box, there's a link being provided by our admin. You can click on the link to provide us with your feedback. So two ways, I repeat, you scan on this QR code, or else in the chat box, there's a link. Please click on the link. I'm going to give you a very quick 30 seconds for you to provide us with your feedback. Now, meanwhile, for those who would like to submit your question, you can start to submit in the Slido tabs, and we are going to pick up your question. Okay, for those who already submitted your feedback form, thank you very much, and we really appreciated your help for providing us with your feedback. For those who not yet finished, you can continue with the feedback form. Now, this is the steps. Again, you can follow these steps to submit your question. Now, CY, for the first question is, can price action be used in day trading? And the second part is, can it be used for trading in different time frame?
Okay, for price action trading, it can, in fact, can do for multiple time frames. Okay, the most importantly is depends on what tools that you use. Okay, so for example, earlier I shared with you is that price action trading. If you look at price patterns, we have immediate patterns that look at 1 to 3 candles. We have a short-term pattern that looks at least 4 to 10 candlesticks. Correct. So if you are looking at one immediate pattern. In fact, all time frames can look at can do price action trading. Now the challenge here is that whether your chart gives you the opportunity to identify those price patterns or not. So earlier I shared with you, for example, like the FKLI chart. If you look at the 1 minute chart, right, that it seems like a piano candlestick, like green, red, green, almost quite flat at each and every level. So those the time frame might not be necessarily be suitable for price action trading for 1 minute chart. So this is where you need to be able to switch to another different time frame. So instead of using 1 minute time frame, you can switch over to see whether, for example, 15 minutes or 30 minutes is suitable for you to identify or even spot your price action reversal or not. If there is, then you can use those strategy for intraday or even very short-term trading. Another example is that if the market is actually very volatile, for example, like the FCPO market, right? For 1 minute chart, it can be very volatile. So this is where, for a volatile market, then yes, using 1 to 3 candlestick to identify reversal patterns can be pretty effective because it gives you the opportunity for you to do that. And the challenge here is that, again, you need to develop your trading strategies, meaning you need to find a good trading setup that is trading for that particular pattern, because identifying pattern is just only step number 1. Okay, step number 2 is that even though you identify, for example, if you look at the doji pattern, okay, a cross pattern at the top of the chart or at the bottom of the chart, you need to know what is your trading setup. How are you going to trade that doji star pattern? Okay, when are you going to enter? Is it right now or later? When are you going to cut your losses? Are you going to cut your losses on the next candle, or how many points you need to cut? So this is where, identifying spotting patterns is one thing. The second thing is that you need to know to develop your whole trading setup just only for that pattern. So here you can see when we do price action trading, right? There are a lot of homeworks that you need to look at before you improve your trading edge using price action trading.
Okay, since you're on this question, right, there's one quite similar question asking about what is the ideal time frame for price action trading?
Okay, the ideal time frame for price action trading is that as just now I believe I answer that also already. In fact, whether is it ideal time frame or not, we want to look at the volatility of the market. if the product is very flat, not volatile for 1 minute or even 5 minutes is also not volatile, then we want to look at a higher time frame. Okay, because a higher time frame will be able to provide you an accurate interpretation for example, if you're looking at candlestick patterns alone, higher time frame may be able to provide you a better interpretation. However, if you are using the medium term patterns to trade, right? For example, if you're looking at double top, triangle, and those things, support and resistance line, then those are the time frame that can be used across all multiple time frames, because there is no hard and fast rule to talk about which time frame is ideal to trade, because when it comes to price action, right, there are so many tools for us to use. So it depends, it all boils down to whether your tools that you use is suitable for that particular time frame or not. If a market that is too flat, not volatile, then probably you want to increase the time frame so that you can have a better and accurate interpretation.
Okay, the next question is price action similar to SMC or ICT or not?
I'm not quite sure what does SMC or ICT refers to. Probably you can.
I suspect he's asking about smart money concept.
Smart money concept. Okay, price, if it's a smart money concept, then yes. Again, just now I shared about the assumptions of price action trading, right? So when you follow those assumptions, because when you do price action, you believe that your assumptions is actually true. You believe that whatever market price that you look in the market, for example, if now there is an engulfing pattern, if there's a shooting star or whatever candlestick pattern that you look at your chart right now, okay, you believe that the market participants are looking at the same thing. They have also taken whatever trading decisions that they want to take. For those smart money, if they want to leave or quit the market, they would have already, already slowly distribute and exited the market already. So, which is why price action, it's in fact in another way is that yes, it is quite similar to smart money concept, because it gives you a quicker way to enter the market. It gives you a quicker way to exit the market. So the fastest way, okay, among price action, right? If we were to split it into the speed of trading, identifying 1 to 3 candles, actually the speed is actually very fast, because you don't need to look at too many information to make decisions. So as you increase the number of candlesticks to observe your decision making, right, you are actually looking at more information already. So when you have more information, it means you need to be a little bit more patient. Your decision making, your entry point would be a little bit slower. So which is where of course, if your decision may be a little bit slower, your return might not be as high as those who enter the market first.
Oh, okay. The next question, right? Because of time limitation, we're going to take the last 2 questions. The question is like this: should we consider the wick when we decide for entry points or not? And followed by the next question is how to avoid fake breakout.
Should we consider entry points? Yes, entry points is actually very important for all tradings. No matter what strategy, okay, not just only price action strategy. Even though we have a lot of money, right, we can't just simply shoot at any entry points to enter the market, because entry point is the deciding factor that whether you are going to increase the amount of money that you make or the amount of money that you lose. If your entry point is incorrect, the probability of winning is low, the amount of losing would be high. So which is why entry point, when it comes to selecting strategies the best ideal strategies to trade is that we always want to look at having a good entry point. That is number one first. Okay, when you are able to identify good entry points, that is consistently, then the second thing that we want to look at is on the risk management on those entry point. Okay, because no matter how good the entry point is, there will be always risk there, because anyway, it's the market, right? We can't really predict what is going to happen next, what the market is going to present us next in the market. So for example, like the breakout example, whether we can avoid a false breakout scenario, is that the answer is less likely. Okay, we will not know if there is a breakout until it actually happens. Okay, so for example, whenever there is a breakout signal and we enter that particular trade, so this is where as we enter the trade, we also need to prepare ourselves where and how we are going to manage that particular trade. Where are we going to cut our losses? When are we going to exit this trade? How do we know that we are in a wrong position? Okay, so this is where entering a breakout trade is one thing. We need to know that we are able to identify it is a false breakout also. So this is where when you are able to capture both sides, knowing when is your entry point and also knowing when you are actually wrong in the market and get out of that trade, so that you are able to protect your capital and wait for another trading opportunities.
Okay, because of time limitation, we couldn't cover all the questions. We can only cover questions related to this topic or those who have submitted earlier. Now, subsequently, we are going to move to the feedback form. Just now, if you not yet submit your feedback form, please appreciate to provide us with your feedback. You can click the link in the chat box, or else you can scan this QR code. You can still continue to submit until the end of today. Now, last part. Next week, next Tuesday, we're going to have the last Let's Learn Futures webinar series for this particular year, 2024, and we are going to end the session for next Tuesday. Subsequently, we are going to restart in 2025 in January. So please do not miss the last session for this year, which is Unlocking Trading Success with Diverse Styles and Time Frame. So if you would like to attend this particular webinar session, please scan this QR code, or else in the chat box, there's a link. Please click on the link to register accordingly. And please mark your calendar and remember to attend on next Tuesday. Now, once you click on the link, you're going to come into the event page. You click on, or you select the Tuesday column and you click on the last session itself and you can register accordingly. Now, the last part, beside the Let's Learn Futures webinar series, we also have Let's Learn Futures online workshop. I can see some of your questions in the Q&A box or the slider box are very basic. So if you do not have any basic understanding about futures trading, I strongly encourage you to go and join this online workshop 1 and 2 so that you can understand everything regarding futures trading. And this topic, we handhold you to guide you from A to Z, for you to really understand how do you kickstart in your futures trading journey. So this will be the last class as well on 30th of November. It is a Saturday. So for you to register, please scan this QR code, or else in the chat box, there's a link. You can click on the link to register. Now for your information, because this is an online workshop, unlike webinar, there's a limited seats available. We open for 150 to register, but on the day itself, the first 50 online attendees we will only admit. So please remember to register and attend, and remember to attend, because the seat is really very limited. If you couldn't attend it, please do not register. Now, once you click on the link, it comes to the events page, you select the session on 30th itself. So please attend the workshop 1, then only attend the workshop 2. So please register for both sessions and you attend accordingly. Now, the last part, This is the derivative trading simulator provided by Bursa Malaysia, and you can access to bursamarketplace.com/mkt/DTS. So Bursa Marketplace is the page owned by Bursa Malaysia as well, so it's quite safe for you to access to this DTS. You can simulate, you can do anything that you would like, and you can trade with a capital, the initial capital provided in a simulation environment. Now, last part. For Bursa Academy is a comprehensive one-stop e-learning platforms. So for you to access to it, you can scan this QR code, or else you can access to bursaacademy.bursamarketplace.com. So this comes to the end of our session. Sorry for the delay, but anyhow, thanks for your participation and thanks for joining us the session. And we are going to see you on next Tuesday. Have a great night and good night. Bye-bye.